From the morning reading, the SPX posts the largest one-day rally of 2016. Positive earnings reactions by multiple companies helps the day. All 10 sectors moved higher on Monday. XLV, XLF, and XLI were the strongest sectors, while XLU was the weakest sector. Oil futures rose 82 cents to close at $44.95. Breadth strengthened compared to the prior session as advancers led 24.91 to 551 on the New York Stock Exchange and led 22.23 to 543 on the Nasdaq. On the S&P 500 snapshot, a low-volume FBI relief rally. The S&P 500's 9-day sell-off, the longest in 36 years, ended with yesterday's session with the relief rally triggered by the FBI. Letter to Congress on Sunday from FBI Director James Comey reaffirmed its earlier stance on Hillary's email server. The pre-election surge of 2.22% wiped out about 70% of that 9-day sell-off. The 10-year note closed the session at 1.83%, up 4 basis points from the previous close. The stock surged on the pre-election FBI announcement as safe haven assets slide. Rising dollar hurts gold. Mexico leads emerging markets higher. Rising base metals boost Aussie dollar. Airlines lead transports in bullish breakout. Transports have broken out. The Dow Jones Transportation Average closed at a new 52-week high on Monday, while the Dow Industrial Average hasn't set a new high for more than 50 days and remains more than 2% below its own high. The transports are seen as a leading indicator for the broader market, but that is an anachronistic cliche without much to back it up. The S&P 500 surged as well. The index went from a multi-month low on Friday to wiping out more than a week's worth of losses on Monday and surging to its best one-day performance in more than 6 months. Similar surges from a low have led to mixed returns with a modest positive bias when it happened while the S&P's 200-day average was rising. The Dow finally broke out, kind of. In the October 24th report, we looked at times when the Dow Jones was stuck below its 50-day average but above its 200-day average for at least 30 days. It finally broke out to the upside above its 50-day. Dating back to 1898, there were 10 other upside breakouts, and the Dow's best returns going forward were 2 weeks later when it was up 7 times, down 3 times for an average of 0.8%, a bit better than random. But 6 months later, it was positive only 6 times, and its average return was only 0.6%, well below the random 6-month return. And also in the morning reading, one author indicates shorter-term indicators like the VIX and the STOs have suggested a snapback rally. The author believes that is what we have here. Ultra-short-term indicators imply a continuation of the rally over the next few days. However, intermediate-term indicators and the probable exhaustion gap suggest a very short-term rally of maybe a week or two before the gap is filled and price resumes an intermediate-term correction. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:13 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 8th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and jump into the morning. Okay, there we go. The morning report. At the time of this cut, all 4 of the broad market U.S. indices were down just a little bit. In fact, only the Russell's down at 0.25%. The others are all basically down just below scratch. Crude oil is down about 0.5%. Euros right at scratch. Bonds are up about 0.25%, and gold is up just above scratch. and overseas action in the markets that we follow. China's up about 0.5%, so is Hong Kong. Japan's down, and also Germany's down just below scratch, as is the United Kingdom just above scratch. The U.S. macroeconomic reports for today of note include, obviously, it's election day, though results won't be in until after the market closes. So this will mostly be about just anticipation without any real information during the market hours, other than perhaps just how many people are going to the polls and whether it looks to be a high turnout or low turnout, and some entry exit polling kind of thing. But for the most part, real information won't be had until after the market is closed. In terms of other macroeconomic reports of note, you have the JOLTS job openings, mortgage delinquencies, and that should take care of it. Looking forward to tomorrow, you have the weekly crude oil inventories, the 10-year bond auction, and that looks to be about it. In terms of current volatility, obviously, big up day yesterday and helped curb some of the volatility. And we normally think of up days as not volatile. Obviously, yesterday had its own price volatility, but big up days don't add to the fear. And you normally have volatility as we measure it, such as the VIX, will look to come down, even though it was a big up day. Short-term VIX at 24.67. Skew still elevated and in the warning area at nearly 135. IV percentiles came down as you would expect yesterday, with the S&P at a 52, the Russell at a 35, the Nasdaq at 38, the Dow at 45. There were standard deviation size moves put in on all four of the U.S. broad-based indices yesterday, one standard deviation size moves. And let's go ahead and go to the charts and get this turned white for you. It's a little easier, I'm told, to see. And here we go yesterday with yesterday's price candle. And indeed, you had the big professional type gap, but then a continuation. So very, very impressive bullish action. Wiped out about 70% of the prior week's move down. Frankly, it puts us right back smack into the trading range. So the question still remains, what do we achieve now? We've not even broken above the diagonal resistance. So we're just smack in the trading range. So we'll see if we get any kind of continuation and we break out above this diagonal resistance. If we start making higher highs, which would require a break above 2150 area, that's when we really have something that's been achieved. And then, of course, as one of the morning authors put it, we may just simply be in a bit of a snapback relief rally for short term, for several days, and then just see a continuation in the intermediate term pattern towards a correction. So more to be seen here, but very, very impressive short-term bullish action yesterday. Same thing on the Dow. We're kind of right back into the overall trading range. We did break the near-term resistance area with the Dow yesterday, though we're trading right back to it right now. So right now it would seem that pattern is just kind of very neutral and very much in the middle of the overall trading range from the recent, several weeks. And then Nasdaq also very impressive up move, but in the bigger scheme of things, we're in the middle of the cloud, middle of the trading range, just very, very neutral. So we have yet to see something, really be achieved, other than a very, very impressive one-day rally. And here's the Russell. Same thing here. Lots of moving average lines above. This, of course, was the weakest of the four indices, and lots of overhead resistance. Long way to go just to get back to the prior swing high at about 1230 on the Russell futures. And other markets, here's crude oil, and crude has at this point, undercut the 50% fib retracement, almost got to the 618 fib retracement before that reversal action yesterday. And again, we'll watch to see if we can summon. I mean, you got a long way to go with this huge drop without even a swing high being put into place. Right now, this would be the next swing high, and that would be a very much lower swing high. So this has got a very long way to go to be able to establish a higher high in the current trend. Right now, I would put this as a very wide, complex consolidation pattern, and right now it's kind of in the middle of that pattern, like so many of the other trading markets, and smack in the middle of the cloud. Very, very neutral in the big scheme of things, and yet these ranges are exceptionally wide, between some 52 and change and 39 and change. So you've got to kind of recognize that. Gold, of course, the most recent action has been this rise up towards the resistance area and then failure from there. So at this point, we have a lower high, and the intermediate term for gold continues to be lower highs and lower lows, and we'll see if that continues. Gold had been bullish for months on the intermediate term and has decidedly turned since late summer to a more bearish intermediate term trend. And then also, let's take a look at bonds. Bonds have been a sideways consolidation pattern. One of the things I thought interest yesterday was that despite the very large move in equities, you saw very little relative move in bonds. So the bond traders, which are supposed to be the smart money out there, they weren't very much moved by that FBI letter and really made no change in their relative position. So, and the bond market's much, much larger than the equity market. So, kind of interesting potential tell there that they weren't buying, that there was really anything new in the market. And if that's true, then the market move yesterday would be likely to stall out and retrace at some point. Here you see the VIX, big crushing action with yesterday's action. So far today, it's up actually a little bit. So we'll see where volatility goes. Today could be pretty ragged actually in trading, as everybody is waiting for the real news to come out, which will be likely tonight into the next 48 hours. Remember, by the time you learn where control of the Senate is and control of the House is, you know, some of these elections could end up very, very close. And in a couple states where there are requirements for at least 50.1%, there could be runoffs. So this could be actually a while before we actually know where control is. It's that close in the expectations around the Senate race, for example. So let's take one look at the dollar. Dollar did have a big move yesterday, so that was in alignment with what was happening in the equity market. So far today, you know, relatively motionless. Okay, that should be enough on the charts. Let's go ahead and go to the daily report. And, you know, big move, short-term move yesterday, very impressive. But on the intermediate term, nothing really has changed yet. We're still very, very broken and with a lot of indicators that are pointing down. Now, if we get follow through another day or two, we'll start to see these things start to ebb. But right now, market phase 5, the break of diagonal and horizontal support, and those moving average lines have not crossed with yesterday's action to see improvement in that yet. In terms of the market timing signals, no change from yesterday. Uptrend under pressure. The GMI index is still got a sell signal. The stock chart's decision point had no new signals with yesterday. So yes, it was impressive. It was a big one-day rally, the largest one-day rally of 2016, but not enough to repair all the damage as of yet. Position sizing opinions, both models are still at 50%. Intermediate term market posture, this is telling as well. See, that this is what I was talking about, where you've not had enough change to actually change the signals with that one-day big move. The S&P still severely strong bear. The Nasdaq and the Russell also still in severely strong bear intermediate term market postures. Now the Dow did turn with the first day signal into just barely weak bull, so be aware of that. Our primary signal does come from the S&P though, and it's still in the severely strong bear. With the weak bearish sentiment line supporting it, so that would be definitely a negative as well. Overall, hedge warning status still remains level 3. The potential is present. Conditions are present for a crash warning, and that's where the overall hedge warning status currently lies. Option income strategies, covered calls, put selling, all three opinions are still outside the acceptable thresholds to initiate new positions for novice traders. Aggressive, experienced traders may take advantage of these short-term moves to be able to take some actions, but they're more prepared to make the adjustments and take those risks. So for novice traders, this is not ideal conditions, and just as fast as you whipped up some 2% yesterday, you could whip right back down 2% tomorrow, and you've got to be really prepared for that. And for most novice traders, it's probably best to be sitting on hands right now until we get some clarity as to the current trend. In terms of current warnings in the volatility based group, you see still a lot of warnings. Market and decline, sharp increase warning, volatility ratio warning is in a position for a reversal, and certainly we saw the beginning of a reduction in volume yesterday. We'll see if we get follow through on that today. The VIX is still up above 18. We still have a high distribution day count, still have a high skew. We still have a current day market maker move on the SPX of above a 60. So things are still quite elevated. In terms of the trend-based area, 2 of the 3 are in warning status. The New York Stock Exchange, new highs, new lows. Very interesting here. And this shows you just how much damage was done. You know, while there were more positive new highs yesterday than new lows, it didn't even rise to the threshold on which over 300 we take special note. So this was just kind of a relief bounce so far, and we're waiting for confirmation that there's more to be achieved. The intermarket risk aversion indicators all 5 in risk off stance, though there is start to be some evidence of potential rolling up, but not yet have change the angle of attack and so forth enough to be able to see crossovers. In terms of sentiment, a little bit of ebbing of sentiment yesterday. You had the prior session at 14, you went to 26, so now out of extreme fear into the fear area. In terms of sector specific information, you see pretty much a sea of green with just a handful of companies in the S&P 500 that were negative for the day. So pretty much extreme green breath in all sectors, and you see the best sectors performance yesterday well up over 2% and over half a dozen of the sectors. In terms of market postures, you saw quite a bit of healing yesterday with that big move, so no longer the sea of red. I'd like to see more follow through, and really it's hard to make too much of either side on this right now, but certainly we'll recognize that there was significant improvements. Also, with that big up gay, we did see some improvement on the consistency across the different time frames. And again, back to financials, it has been the one sector that has been most consistent in its performance in recent months. And you see it's right now, with yesterday's action, the only one that is green for everything all the way across to the year to date. And really, in the rolling 1 year period is basically scratch. So that one has has basically been the sector, go-to sector when you think the bulls are running. The financials are probably out in front. Okay, that's right at 20 minutes. Let's go ahead and wrap this up for today. And I'll scroll through these slides. If you see anything of note, just hit the pause button and get greater information. Go to the hyperlink, etc. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also, note the hyperlink down here at the bottom for the full set of disclosures. In the meantime, manage that risk. Go learn something each and every trading day, and you'll find that consistency that you are looking for. We'll be back here tomorrow morning for the morning after the election, and we'll look to see just what that has for us in our trading. In the meantime, good trading.